If you just clicked on this video, then you've probably heard of the letters ETFs before, but you're not sure if you should be investing in them or which ones to invest in. Now, choosing an investment option is probably the most, I guess I'll call it, overwhelming step in the investing process because there's so many different options to choose from. First, you need to pick an investment platform and then set up an account. Then you need to actually choose which investment account that you want to buy your investments in, and then you have to choose an actual investment to buy, and that's when ETFs come into the picture. ETF stands for Exchange Traded Fund. Basically, they're funds that are traded on the stock exchange, hence the very obvious name, Exchange Traded Fund. So let's start with the fund part. A fund is a basket of different types of investments, like a stock or a bond, for example, all bundled up and put together for you. Now, not only can funds be diversified by different types of investments, like stocks or bonds, but you can also buy funds that are focused on different industries, company sizes, or countries. For example, you could have tech funds, you could have a US-only fund, you could have large company funds, and then on top of that, you can also mix and match them and make them more specific. So you could have a large US-only tech company fund. Anyways, the gist is that a fund is a basket full of different types of investments that you can buy all together, and you get to choose what type of basket you want to buy.
Now, there's both actively managed and passively managed funds available. We want to focus specifically on passively managed funds because they're typically lower cost and they outperform actively managed funds over 90% of the time. Let me explain. When I say actively managed funds, this means that the basket of investments is controlled by a fund manager. So a real person who's actually deciding which investments should go in or out of the fund over time. Now that's the active piece. There's a person who's actively choosing which investments are best with the goal of either beating or outperforming the market. They decide what to buy and what to sell and at what time in order to get those best results. The thing is, fund managers don't beat the market long term 90+% of the time. And seriously, there's been countless of studies that have shown that trying to guess which investments are going to be best over decades will actually lead to lower returns almost every single time. And you also pay more money to make less money. That's because actively managed funds have higher fees. And I mean, there's literally someone who's involved whose job it is to actively manage the fund. And those fees typically are around 1 to 2%. Now, before you think that 1 to 2% is a low fee, it's not. You have to think of it as a percentage of your total return being taken off. For example, if you invested $1,000 a month for 30 years and had an average annual return of 8%, which by the way is a pretty strong total return, you'd have $1.4 million. But if you had to pay a 2% fee, that would actually be 25% of your total return, meaning that you would actually only have $900,000. And it would also mean that you paid over $500,000 in fees. But the good news is that passively managed funds also exist and their fees are not nearly as expensive, and they also typically perform better. So that's definitely the type of fund that we want to talk about. I also want to quickly mention that people sometimes say that it can be helpful to have an active fund manager or even a financial advisor because it can encourage them not to panic or sell off their entire portfolio when the markets are down in the short term. Listen, our personal take is that we'd rather teach people how to manage their own investments and actually choose investments that they're comfortable with, especially when it comes to holding them long term, instead of having them pay thousands in fees over the next few decades.
Funds in general were created to make diversified investments more accessible. It lets you have access to more investment options because having to buy stocks individually can be expensive, and it also makes it harder to reduce your risk through diversification. Diversification basically just means that you're reducing your risk by not having all of your eggs in one basket. Like, let's say you had all of your money invested into Apple stock. That might seem great right now if you were to look at the long-term returns, but if all of a sudden that one company were to crash tomorrow, all of your money would be completely gone. That's it. Obviously, that's pretty risky, and one way to reduce that risk is to have your money invested in a mix of multiple different stocks or in different investment options that are specifically spread out over different industries and different global markets, aka having your money invested in funds instead of buying individual stocks. Okay, so now that leads us into our next important explanation. What's the market, and how do passively managed funds work? Now, passively managed funds are still a basket of different investment options that you can buy all together, but this time there isn't a person choosing what's going into the basket. Instead, the fund is passively managed, and the goal isn't to beat the market, it's to match the market. Again, there's no person that's picking these investments. The investments actually don't have to be picked at all because they're literally just matching a market index that already exists. An index is a portion of a financial market. Now, I think it's easiest to picture this if we use an example, and I'm going to use the S&P 500 because that's one that a lot of people have have heard of before. Now, the S&P 500 index looks at the performance of the 500 largest US companies, so how much those companies' stocks go up or down altogether. Now, you can buy a fund that tracks that exact market index, so a fund that contains a tiny piece of those same 500 companies, and then you're guaranteed to make almost the exact same return as the overall 500 largest companies in the US would make in any given year, minus whatever smaller fees you're still paying. Now, there's multiple different funds that all track the S&P 500 market index. There's VOO, IVV, SPLG, and SPY. Now, they're all very similar, like they literally track the exact same companies within them, but they're offered by different companies that have slightly different fees. Then there's also multiple different market indexes you could track. Like there's the total US stock market, there's US only tech stocks, there's the total Canadian stock market as well. Pretty much any country or collections of different countries around the world have an index you could track, and then from there, there's also different industry and company size breakdowns too. That means that there are a lot of different funds and specifically ETFs for you to choose from.
Okay, now we've covered funds, but what are ETFs specifically? Well, ETFs are funds that can be traded just like a stock can, meaning that they can be bought or sold multiple times a day, and you have control and accessibility to your investments. Before we even get into how to choose which ETF or ETFs to invest in, I first want to take you through an example of everything that we've basically covered so far. So let's say that there's a basketball making company, and this company went public, meaning that you can now buy shares of this company, aka a stock. On top of that, let's say that this company is also trading within a sports ETF. This ETF covers the top 100 companies in the sports industry, including basketball, of course. ETFs, like individual stocks, can be bought or sold on the stock exchange. Now, you could spend more money buying one share of every single company, so let's say all 100 of them, one by one, or you could spend less money and buy one share of the sports ETF. It's less expensive and allows you to be equally invested in every single company, despite the fact that every single company also trades at a different price. Now, once you buy this fund, the index of all these individual stocks all together and the performance of the sports ETF are aligned. So on days where the market's doing worse, then the price of the ETF is lower. And on days where the market's doing well, then the price of the ETF is actually higher. So that's how passive ETFs work. Now on to the next question, which is how do you know what ETF or ETFs that you should actually be investing in? There's a few things to consider to help you narrow this down, so let's go through the list. First off, what are you investing for? Are you investing for retirement, so the long term? Are you investing with the purpose of buying a house, so short term to medium term? Also, how old are you right now? Are you in your 20s and you won't be touching your investments for decades? Or are you in your 50s and you're looking to start using your investments to fund your life over the next handful of years? Those two considerations specifically impact how risky you want to be with your investment choice. Basically, the longer that you plan on having your money invested, the more that you can handle low returns in the short term, as long as that long-term return is higher. If we go back to looking at the S&P 500 index, for example, you can see that the long-term return always trends upward. But for little segments at a time, the return is actually negative. If you're investing for 5 years, then that might be too risky and that you could need your money during one of those down periods. But if you're investing for 30 years, then the risk might not be nearly as big. Sometimes people think that this risk level should be based on your risk tolerance, so basically how comfortable you are with investing. But in our personal opinion, it should be based on how long you plan on having your money invested for. Also assuming you're investing in a passive fund. If you're investing for a long period of time, then you might want to lean more towards all equity ETFs, so ETFs that have only stocks and no bonds. On the other hand, if you're investing for a shorter period of time, then you might want to lean more towards ETFs that are more diversified with their investment options, like including bonds.
Okay, there's a few more considerations on the list. Where do you live? Do you live in the United States? Do you live in Canada like us? Do you live anywhere else in the world? And also, do you want to invest in a specific type of company, like just technology companies, large companies, the total market, etc.? Where you live impacts the ETFs you'd pick for a few different reasons. Now, one reason, and I'm going to use my own personal experience as an example here, I live in Canada. Now, if I wanted to invest in the US stock market, specifically the S&P 500, I could buy a fund called VOO, but I'd have to pay the conversion fees in order to buy it in USD, as it's listed on the New York Stock Exchange, even though my money's in CAD. Or I could buy a fund called VFV instead. Now, it's the exact same ETF, except it's offered in CAD because it's listed on the Toronto Stock Exchange instead, and that way I could save some money and not pay those conversion fees. The other thing to keep in mind is that there's also some tax implications depending on which one that you buy and which investment account you buy it in. On top of making sure that you pick a fund that limits your fees based on where you live, there's also something called home country bias. Home country bias is when you have a higher portion of your investments in companies from your own country than someone who lives lives in another country would just because you live there. Now, this isn't necessarily a positive or a negative thing, it's just a fact that it tends to impact people's investment choices. Now, it could be favorable from a tax benefit perspective to have a higher home country bias, but on the other side, it could also be unfavorable if you live in a country that has more volatile or unstable financial markets. Now, we could definitely do like a full-on discussion on this, and we might do a dedicated video to it in the future, but for now, we just want to mention that where you live might impact how much you want to invest in your home country. Now, after factoring in all of these different considerations, you should be able to start narrowing down your search regarding what ETF or ETFs you want to invest in. Now, something that I think is important to touch on is fund overlap. If you do decide to invest in multiple different ETFs, you want to make sure that they don't both contain positions in the same stocks. So for example, let's say you invest in VOO, the S&P 500, and also VTI, which is the one that covers the total US stock market. In that case, you'd have exactly 500 stocks that are overlapping because every single company that's in VOO is also going to be in VTI. What that means is you're basically double dipping, and it can throw off the balance of your portfolio. On the other hand, if you wanted to invest in the total US stock market and the largest stocks in Canada, then you could invest in VTI and VCE, and you wouldn't have any overlap because no company is both American and Canadian at the same time.
I also want to mention that there's funds that contain other funds within them. And the reason I bring this up is because that's exactly what me and Steph do. We actually invest in a fund called XEQT, which contains 4 other ETFs within that one fund. The 4 ETFs within XEQT are all passive funds that track various market indexes. So we're talking the US market, the Canadian market, the international market, and emerging markets. But a company called iShares bundles them up together for you into XEQT and also keeps the 4 funds in a specific balance amongst each other. And I'll throw up the breakdowns so that you guys can see. Now, if we didn't buy XEQT, we actually could buy these 4 funds individually and just do the math ourselves to see if we're hitting that exact balance. So for example, buying 10 shares of this fund, 2 shares of this fund, etc., etc. But what we do is we personally choose to pay a small fee in order to just have XEQT bundle it up for us instead of having to worry about that exact balance. Now, I do also want to mention that there is a free product depending on which brokerage you have called Passive that you could use to do the calculations for you, and then you actually going in and doing the manual work of actually having to buy the funds. So to sum that up, XEQT is kind of actively managed, but we aren't trying to beat any markets. Instead, we're investing in passive funds that track the market, and we're globally diversifying ourselves by tracking 4 market indexes instead of 1. Okay, so once you figure out what ETF or ETFs to buy, we recommend that you look into low fee or no fee platforms to do your investing. You can check out our video all about how to invest for the first time if you want to know what your options are. But if you're in Canada like us, we use Wealthsimple and Questrade, and we have links down in the description box below if you want to check them out. Anyways, we hope that this helped, and if you have any questions, ask away down in the comments, and yeah, we'll see you next week with another video.